So quite a bit of pricing data on offer this week, and this is after the number of central bank decisions that we got last week, which we are going to process here before getting into the week ahead. So let's go ahead and get started. U.S. Federal Reserve last Wednesday, hawkish hold, kept rates unchanged. Market pricing, courtesy of Refinitiv, that we're going to be holding at these levels for quite a bit of time, pushing out the first rate cut from current levels and play for around July is where it's showing a slight majority that we might get a rate cut from these levels. And then when it comes to any rate hike, keeping the door open, a significant minority, and not just for the Fed, but for quite a number of the central bank majors, showing quite a number that they're keeping that door open. Of course, that depends on what kind of data we get between now and then, but keeping the door open on another 25 basis point rate hike. So Fed on hold, PBOC on hold. That shouldn't have come as a surprise. The Bank of England, though, and this was last Thursday, that was where we did get the surprise in the sense that split vote, but they opted to remain on hold. And of course, one of the biggest issues when it comes to central banks holding at this stage is that a lot of times market pricing is going to turn around and say, oh, that means we're at the peak. They might keep the door open, and of course, members might come out afterwards, as we saw with the ECB when they had their dovish hike, not last week, but the week before. We did see a lot of members come out and say, oh, hold on a second, and try and keep the door open to prevent market pricing from saying that this is the peak, and at the very least, to push out any chance of a rate cut so that at least they can stay within the higher for longer narrative, regardless of whether the economy can actually withstand that, because a lot of the data that's been coming out has been quite disappointing when it comes to some of these regions. So Bank of England, they're also on hold, and did not come off as hawkish, obviously, because it didn't come with a hike. Swiss National Bank was on hold. That also came as a surprise given what markets were pricing. But given that CPI is below target, even if they anticipate it's going to go back up, seen as less of a surprise compared to what we saw out of the Bank of England. Bank of Japan, they were on hold. That wasn't the surprise. The surprise was that they didn't come with any sort of hawkish tone, so to speak, especially because of USD JPY. When it got to 148 before, we heard from the Bank of Japan's Ueda, not last week, but the weekend before that, where he came out and he sort of caused that gap lower to 146. USD JPY went back up again, and now it's above 148. And the expectation was that, okay, now they're going to have to do something a little bit more, maybe not action, but at the very least come out with some sort of tough talk again. And so far, that wasn't the case when it came to the meeting, and that was kind of the surprise when it came to the Bank of Japan. Now, when it comes to the remaining out of the G10 currencies for the central bank, we did get hikes from Norges Bank, +1, saying additional one likely when it comes to December, and Sweden's Riksbank with to 4%, taking it up by 25 basis points as well, and keeping the door open on another. And then when it comes to emerging markets, the story's a bit mixed over there. You got rate cut out of Central Bank of Brazil by 50 basis points as expected and signaling more. You had South Africa on hold at 8.25%, and then you had the Central Bank of Turkey taking it up by 5% to 30%, though. And a lot of you thinking, well, that's a pretty high number, but given where inflation is at, that's still seen as relatively low for an emerging market. So that's when it comes to central banks, where market pricing right now, for at least when it comes to the G10, generally either we're at the peak, very near to the peak, and for those that are at the peak, sort of keeping the door open, but a significant minority on another 25 basis point final rate hike. And really for now, we've shifted from rate increases to more higher for longer, stressing the higher for longer narrative. But here's the thing, it really depends on where pricing goes. And that's the reason why when it comes to the week ahead, pricing data is going to be very important. Now, USPC figures that are going to be released on Friday, the Fs are Friday. These are for the month of August. So headline month on month is expected to be strong just because of what we saw in terms of energy. And the core year on year, though, is supposed to drop from 4.2% to 3.9% with month on month growth in a stable 0.2% rate. It's kind of what the Fed wants to see. 0.1, 0.2% month on month is kind of what they're looking at. Eurozone preliminary HICP, or Harmonized Index of Consumer Prices. This is for the month of September. Preliminary figures, crucial. And year on year, both headline and core are expected to drop beneath 5% from 5.2 and 5.3% respectively. And then on the same day as well, you've got Tokyo CPI readings. This is for the month of September, which is why it's so important. That's also going to be released on Friday. So, this is going to precede the figures that we get for the nation that come out later on. So all eyes on these three. Australian CPI, by the way, that's going to be on Wednesday, and that's for the month of August. And when it comes to other items in the week ahead, you got CB's consumer confidence figure. If it takes another hit, usually it's more sensitive to the job market, whereas U of M is more sensitive is more price sensitive. So that's why we saw a bit of a divergence between U of M's consumer sentiment versus CB's consumer sentiment. You also have GDP, not really a worry, because both for second quarter as well as for the quarter that we're in, given the estimates that have been coming out, like Atlanta Fed's GDP now estimate, you're going to get quite a bit more housing data, where the story is still a matter of those locked in on lower rates don't want to let go. And you're going to get Chinese PMIs from CFLP. These are going to be on Saturday, so markets are going to be closed. You don't need to worry that much in that regard. I'm going to go ahead and pull up just to take a look at IG's trading platform here, GBP USD. And here's the thing: the pound. I mean, the dollar didn't underperform last week. It did outperform, but it wasn't the top performer, even after the hawkish hold out of the Fed. But the hawkish hold out of the Fed did aid the dollar when it came out. You had weaker, lighter than anticipated CPI readings, taking BOE market pricing probabilities back, and then you had the BOE with its hold, and that really meant that the pound suffered. And on the shorter term time frame, it's starting to look a bit of like a bear average situation. But here's the thing: it's the fundamentals that sort of triggered this. So whether or not we continue to get this will be another matter. And I'm just going to go ahead and pull up this week's weekly market report and take a look at GBP USD. Interesting enough to note that COT speculators, they were holding a heavy buy bias in the pound. They're starting to pull back right now, and they're down to just 62%, no longer in heavy long territory. Retail trader bias, by the way, jumping up on the, shorts getting out, longs going up, and that's taken up to 74%. So that's about it from our end. I want to thank you guys so much for watching. Good luck out there, and as always, happy ticks.